Please welcome the panel on Public Market Paradigm, Strategies in a Volatile Investment Landscape, moderated by the business editor at Axios, Dan Primack.
Morning. Oh, I like the music. Thank you, everybody. I think Jimmy told me that the sign of a successful panel is if you have more people in the audience than people sitting on the stage. So we did it. We could almost all go home now. Success. Very happy. Thank you all again for being here this morning and working off whatever you did last night. I guess let's start just by introducing people, and we'll do this fairly quickly. I'll just start, and we won't be going down the line. This is probably the only time I'll ask you to do this. But Alex, we'll start with you. Just explain a little bit about yourself or the firm, and also just for kicks, I'm going to guess none of you wanted to be asset allocators or hedge fund managers when you were a kid. What did you want to be?
Okay. Pleasure to be here. Alex Roepers from Atlantic Investment. I grew up in the Netherlands, came to the States in 1980, did some corporate development work, buying and selling companies for two conglomerates. And I learned in the 80s with that to dislike illiquidity and dislike paying premiums for companies. So I decided to start Atlantic with a private equity approach to public equity, and started in 1988, some ups and downs, basically had a hedge fund, a long-only fund, and grew over time. And still doing the same strategy today, which is basically a highly concentrated 8 to 10 stocks of value stocks in the $2 to $10 billion market cap range, where we are 1 to 5% shareholders, never do proxy battles or get onto a board, but we are actively engaged for sure. And with that, being in predictable, reliable cash flow generating companies at low multiples, we've been able to build up a very good record with no leverage. The goal is to have over a very long period of time, it's over 33 years now with the record, to keep going. Obviously a great example is Mr. Buffett, who's got an incredible record, but we've done about 16% gross returns with this approach without leverage and good liquidity. Did I want to become a hedge fund manager or a concentrated active manager? No, I didn't know that. I know I wanted to be in business, and through the corporate development work, I got into this particular strategy.
Alyssa?
So, Alyssa Reeder, I'm the Chief Investment Officer at Common Spirit Health. We're one of the largest nonprofit healthcare systems in the United States, and in 24 states, and have about 20% of the U.S. population in our service area. And when I was a elementary school student, I told my friends that I was going to be a stockbroker when I grew up, because my dad had talked to me about the power of compounding, and I realized that saving money, and if I saved it for 50 or 60 years before I retired, that was like incredible. And so that was pretty exciting.
All right, we've gotten two and not like movie star baseball player. Okay, go.
Yeah, and Albert Einstein, compound interest, the eighth wonder of the world, right? So good on you. Steve McLennan, I work for the Ontario Teachers Pension Plan. We are a $260 billion-ish Canadian plan. We're really tasked with the retirement security for the 340,000 active and retired teachers in the province. We're a defined benefit plan. Fun fact, we've been fully funded. The Canadians have a bit of a different pension model than what you might see in the U.S., and I'm sure that will come up a little bit later, but we've been fully funded for the last 10-ish plus years. We've been around for about 30 years, and it's in our current configuration, and have had really solid risk-adjusted returns over that period of time. You kind of asked a bit of a trick question. I didn't expect what did I want to be when I grew up, and so I'm kind of trying to think back. That was a little while ago. And actually, I don't know if it was a stockbroker, but it was something along those lines in terms of kind of the aspirations. And so sometimes life turns out well.
Jimmy?
Jimmy Levin. I run Sculptor Capital. It's a $35 billion alternative asset manager focused on private real estate markets, private credit markets, and a multi-asset, multi-strategy public markets fund. I've been there for most of my career, about 20 years. What did I want to do? I got into the business. I didn't really know. I know I wanted to do something in business, and I thought maybe be a movie producer. A lot of good books about the famous movie producers of yesteryear. And there was one dad in my town who seemed really successful, which was a goal of mine, and I asked him, and I said, how maybe I should go be an agent or a producer, and he said, do you know what a hedge fund is? I said, no. He said, all right, I'm going to send you a box of books, and you let me know. And so the rest was history.
Hi, I'm Ryan Israel. I'm the Chief Investment Officer of Pershing Square Capital Management. We manage about $18 billion, and it's primarily in permanent capital strategies, which allows us to curate very careful selection of what we call high durable growth companies with strong competitive moats. And I think in an increasingly volatile and you could argue shorter term focused world, our advantage of permanent capital really allows us to invest with a longer term horizon, which we think has been increasingly valuable over the last handful of years as the world's become shorter term orientation. Been there for about 16 years, and then prior to that, I was an investment banker at Goldman Sachs. When I was a kid, my first desire was I wanted to be an FBI agent because I love the investigative reporting and the investigative aspect of it. Fortunately, I'm able to get that in a lower risk way at Pershing Square while still getting to do a lot of the investigative research that I've wanted to do since I was a kid.
Everybody, thank you. So obviously the talk of most every panel and most every keynote over the last couple of days here at Milken has been tariffs in some way or the other, and kind of everything that has flowed from that on the macro side and really on the company side. Jimmy, maybe let me start with you and ask, it's too kind of cliche to say, are there tariff trades? But when you think about how your strategy today, as opposed to a month and a half ago, I guess at this point, or maybe, a month and a half ago, how has it changed? Have the tariffs practically impacted what you've been doing at Sculptor?
For sure. I think we're out of the acute phase. I mean, that's not some brilliant observation. You can just look at VIX, look at where the S&P is, look at retracement across all major asset classes, and if you take the pre-chaos levels, the max chaos levels, and where we are today, there's been significant retracement. In certain cases, 100% retracement, meaning back to where it was or kind of close enough across a bunch of asset classes. But during that interim window, there were levels of price action that we would all associate with major historical events, right? Again, it lasted for a day at this level, but the S&P was down 25% from its highs. If you just poll a room and say, what's a crash, what's a recession, what's something horrible, they would say the S&P down 25. So while that was going on, a bunch of other asset classes did their version of the S&P down 25. High yield spreads doubling and VIX going to 80 and so on and so on. I won't list them all. So during that window of time, we had the ability to do what we think we're really good at or have done a bunch of times, which is go the opposite way and lean in. And so we came into that episode with the right defensive positioning that allowed us to be offensive during that time. It, like all of these over the last handful of years, feels like it happened too fast. Which might just be how the world works now, right? If you ask anyone,
You think the rebound happened too fast, or the?
I think it happened fast. I think people say too fast because they remember the days when this used to take weeks, months, quarters, years, and in hindsight, that seemed like an easier way to invest. Wow, things go down a lot, and then I get a couple of years to study it and watch and figure it out, and then buy it, and then make a lot of money. And that hasn't really been how it's worked since the GFC. So maybe too fast is the wrong, that's a biased qualifier. It happened quickly, but the news also changed quickly. We went from everything was fine to a series of announcements that would have, if they were followed through with, would have made the economy very much not fine. And then when faced with the market response to that, the policies were, reversed, pulled back, diluted, however you want to describe it. They were materially stuffed back into the bottle from whence they came.
Alex, for you, I mean, how did you handle it? And I guess as kind of a part of that, did you do kind of what Jimmy did, which is lean in, or at least do something in direct response, as opposed to what some people have done, which kind of almost, you could call it the Fed model of investing, which is we're just going to kind of look through this and pretend like it's not really happening right now because we don't know what the policy is going to be in 2 weeks, let alone 2 years.
No. Well, public equity market investing requires a certain temperament. Outside my work, I've done a lot of ocean racing and yacht racing, and one thing I always remember is that Mother Nature is stronger than all of us, and so is the equity market. And when it gets really wild out there, with a squall or whatever, you can quite often see it coming. You hunker down. And the second Trump administration, with what he's been saying about tariffs, was quite known. And the fact that he was going to go for it was not a huge surprise. Then
guys, when you say that, why do you think it was clearly a huge surprise to lots of people?
It's the implementation, obviously. It's grotesque what he did on the 2nd of April. But then you'll it's masochistic both politically and economically. So he's going to have to dial it back the moment the approval ratings drop, or the moment the shelves are empty, the moment people put pressure on him, and all that's kind of happening. So if you look through that squall, if you want to take the analogy to Mother Nature again, nothing really has changed. We pick stocks based on very strong margin of safety, very low multiples, very strong ability to deal with it. We've had the reporting cycle largely, and very happy to say that almost all of our companies are dealing with this very, very well. There's a lot of exemptions, like the USMCA, the automotive parts business. Other companies make locally, sell locally, and so the impacts are very, very much minimal or very manageable. So we haven't really changed much. We did find, of course, in the volatility that Jimmy referred to, obviously opportunities to add to positions or to change a few things around. So
it's interesting when you talk about the underlying performance, and obviously we've been seeing earnings coming in. Granted, that's through the end of March. In those cases, Ryan, when you look inside, again, concentrate portfolio, but when you look, do you feel when you look at you look at April performance from your companies and what management tells you, do you look and say, but we don't really know? Somebody today told me that they viewed April as a lost month. Like, I've seen the numbers and good, but they don't really necessarily mean anything to me because there's been just so much tumult in the month, and Q1 more so.
Absolutely. I think both in terms of the companies that we own, a lot of the hundreds of companies we follow, and then at a macro level, what you've seen is there's been a lot of pre-buying because the tariffs weren't, while they may have been surprising the equity markets, as Alex mentioned, tariff is the most beautiful word in the dictionary. We heard that before the election. There's been talk about tariffs ever since then, and really for the last several months, people have had the ability to start pre-buying. So a lot of companies have seen actually some very strong results towards the end of last year, even in continuing to March. Several of the companies we follow are actually talking about how even April, after Liberation Day, the results are very strong. I think you're entirely right, though. The question is, the reasons people are doing that is they're trying to get ahead of the tariffs. And then the question, what happens after that? When does it stop? I think companies are very nervous on the whole about what's going to happen. There are a handful of companies, and a lot of them are some of the ones that we own, where if you're a capital light, more royalty-based business model, think, for example, some of the larger companies, Google, Uber, those companies which are a little more service-oriented aren't directly hit by the first-order impact of tariffs. They're more likely to, I think, make it through where there should be less business disruption unless there's broader macro concerns. And so when we look at investing ourselves, we think top down, but ultimately we make our selections bottom up one at a time. And so we have viewed this as an opportunity for us. Earlier in the year, we recognized that there were some risks that may not be reflected in the stock market. So we were trimming some of our positions where we felt that there either could be some second order impact to the tariffs. We raised some cash. And ultimately, over the last several weeks...
I'm curious, what's an example? Where would those second orders be coming from?
Well, ultimately, for example, take a company such as Hilton. It's a royalty-based business model. They are a franchisor of this hotel. So they're doing quite well this week, I think. That business is going to do incredibly well, but it could be negatively impacted because the 80% of their business is business travel. If ultimately corporations need to deal with tariffs by cutting their travel expenditures, the second order impact is that Hilton's business would be negatively impacted. So we evaluate those things when we look at each of our investments. In Hilton's case, that was an investment where it seemed like the market did not pay particular attention to the downside risks. And so we were able, in a case like that and several others, to raise some cash. And that proved, I think, very helpful over the last several weeks when there were companies that were trading at levels that were still very discounted. And to Jimmy's point earlier, I think one of the interesting things we've observed as a bottom-up investor, completely agree, the fact that we have retraced 30 days after Liberation Day to get just above where the market was at a whole level for the S&P 500 is pretty fascinating. Interestingly, though, there are a lot of great companies that are not that directly impacted by tariffs that are still down 20% or more. And someone trying to create a portfolio of 10 to 15 companies, that's a really big advantage for us, and we've been trying to take advantage of that opportunity.
Alyssa, similar question to you. And when you think of the managers that you guys invest in, do you, when you start to get quarterlies or even monthlies, do you kind of look at them and say that's nice and then throw them in the trash, or are you paying serious attention to it? I mean, obviously, historical performance always matters. Recent historical performance matters. Sure. But does it matter less right now than it would have in a normal period?
I think one of the things that's been helpful for us is having a few more touch points with our managers and figuring out, are they behaving in the way we would expect them to behave? Are they performing the way we would expect them to perform? Some we would expect to be more, bobbing and weaving in these types of volatile markets, and others we don't expect any changes. And so when people behave in a different way than we expect, that's something we want to dig into a little bit more and look into and understand. And if it's in a way, if they're not skilled at bobbing and weaving and they're bobbing and weaving, that will end up on our watch list. That's not something we're looking for.
Did your watch list expand in April?
No, but it changed. Like we had one when one public equity manager went on to it, but we had a couple other managers go off for different reasons, and so we absolutely care, but it's fodder for the discussions, and it helps because it helps them identify and sort of show, do they stick to their strategy? How are they reacting in these different environments? I mean, one of the biggest challenges for me is that sometimes people on my committee or in my organization expect me to be doing rapid changes related to this, and that's not something that we're set up for. This is not causing major tactical asset allocation shifts. But I am expecting some of our managers to be doing that.
It's interesting. Obviously you're basically having to calm down the people above, essentially.
Exactly. Sometimes.
Steve, similar for you, and you guys have an interesting structure because you're co-CIO technically, right? And explain the difference between you and the other CIO at Teachers.
Sure. So Teachers, we went with a dual CIO model about a year and a half ago, and my part of the business is really focused on the asset allocation piece. I also have the regional offices that report into me, but for the purposes of this discussion, it's really the top-down stocks, bonds, commodities, some of those other items, and my co-CIO and I collaborate quite a bit on some of those more active programs in terms of thinking about the capital into those. One of the things I would just note is that the Canadian model is a little bit different, as I said earlier, around what levers that we can affect. And so we have the capability to invest directly because we have over 400 investors that can kind of go and do things directly, so it can do an infrastructure deal on balance sheet. We also have a team that will look after or look at partnering with GPs and so on and so forth, and then there's a hybrid type of solution in between. We also have the ability to do liquid or illiquid investing, and that really ties to our long-term horizon and plays to that part of the portfolio, kind of akin to the permanent capital argument that one of the panelists expressed earlier. And then the third piece is this ability to toggle between active and passive. And so I think as we've gone through the last couple of months, similar to many of the commentary, it did feel like it was going to be a more uncertain environment. And so our first lever is to kind of just bring down overall risk utilization. And we have a variety of different means to do that. But that was the first step. I think, notwithstanding.
Yes, what's the main lever that you use? What's the
it would be primarily the passive exposures and fixed income equities and those other products. That's your kind of brake or accelerator if you want to kind of really think about it more simplistically if you're driving a car. I think, though, given the fact that we've bounced back a lot, we're spending a lot of time thinking about, all right, what are the implications of this for broader institutional portfolios? Because, again, from the beginning of the year to now, if you were to look at it, nothing's really changed. And, it feels like it's a much riskier environment, or at least that there's a lot of different outcomes and circumstances that don't necessarily feel like they're being fully reflected in the marketplace right now. And we're a Canadian investor, so the other dimension that we have is the Canadian dollar exposure is a big driver of our overall returns. And so how do we think about that part of the puzzle? And so, the U.S. market's been a very substantial driver of our historical returns, just like many of us, both within the U.S. and outside of the U.S. And there is a lot of strengths with the U.S. market as it relates to depth of capital market, productivity growth, and so on and so forth. And so I would expect those to continue. I think the other piece, though, that plays into kind of what the long-term outlook looks like is just relative valuation. And so that's more plain vanilla kind of asset allocation type of decisions, which we would be undertaking in any event. And then we've got this other piece around a fair amount of uncertainty that's been introduced into the system that we're trying to get our hands around without being too knee-jerk and making a reaction that is more difficult to reverse.
You talked about the U.S. capital markets and the depth of them. Is the U.S. today, and the kind of the view from Ontario, is the U.S. as attractive an investment destination today as it was a couple months ago for you guys?
That's a trickier one, and that's part of the work that we're trying to think through here, because again, on one hand, you can kind of create a set of circumstances that make it feel exactly like it was before, but on the other hand, there is a lot of uncertainty introduced into it. And so again, in the interest of not being too knee-jerk reactionary to it. I think we're trying to think through what that looks like, and we'll evaluate.
Do you get any similar wrong, different sort of pressure than what Alyssa was getting, but pressure? I don't even mean political pressure, but kind of blowback pressure. I don't know if you've seen the news, but there's been some things said about Canada down here in the U.S.
Yes, I do need to be careful about how I answer this, but look, I think there's a general
Answer it 51 times.
Yeah, exactly. Look, I think there's a natural trend globally, I think, for almost a repatriation of capital, and I don't think we would be anything different than other parts of the world. And so I think that's something that we want to be aware of and be thoughtful around. But at the end of the day, our job from an investing perspective is to deliver the highest risk-adjusted returns, and that involves a couple of different levers, including diversification. And so I think that's kind of how we're trying to approach that particular problem.
Alex, let me ask you the geography question from a different way. When Atlantic started, you were U.S. focused or U.S. exclusive, and then you expanded investing in Europe, Japan, I think. Right now, do you view the U.S. as attractive as you did, say, 6 months ago? And is there some other geographic region right now where you think that you guys could be expanding, or at least looking at expanding into?
Well, we're talking about 4 markets: Japan, Europe, U.S., highly overvalued large cap, Mag 7, etc., plus bubbles in AI and crypto and what have you, and then the rest of the market, right? I mean, there's a huge bifurcation in the U.S., largely because of passive investing, trend following, zero interest rates for a long time, and we've had a 15-year growth bubble and growth, market that has led to 15% compounding in the large indexes, which have benefited a lot of people. That sets up typically a 0 to or negative 5 to 10 year period for that index coming forward, because that kind of growth is not sustainable, and you can see it in all the bubbles that are going on. So within the U.S., I'd say it's definitely a market that is challenged because it's highly valued in many large cap pockets. And then there's a huge amount of value, just like Ryan said earlier. The S&P might have returned back to flat after all this hoopla, but there's a ton of stocks that are left behind because it was just boom, negative liquidity event, and they went down 20-30%. They're still sitting there at 3, 4, 5 times EBITDA in some cases. And talking about M&A, and where's the M&A market? Where's the IPO market? It's
both dead, I believe.
Yeah, it's dead. Yeah, and so that's because of uncertainty. And once uncertainty comes back, people
and cowardice. But sure.
Let's proclaim the virtues of the public equity market, right? It has volatility. Volatility is opportunity, not risk per se. If you are, smart about where you invest and what you pay for companies. So I think it's, there's a lot of private credit and a lot of private equity discussions at this conference. This is one of the few public equity discussions. It is a phenomenally beautiful place to be. You can instantly buy. They're lamenting that the Wilshire 5000 doesn't, it's a wrong name. It should be 3,500 companies. But there's 15,000 publicly traded companies in the world over $100 million market cap that you can get access to. So there's instant choice. You don't have to pay takeover premiums. You can trade them if you don't like what you see. You can beef them up. So all these things are very good. But back to your question about Europe and Japan. We've been there for over 22 years. Europe is an incredibly attractive market. Again, pick your stocks carefully. There's overvalued pockets everywhere, but there is an immense amount of companies with 4 or 5% dividend yields trading at 5 or 6 times EBITDA, and this is before the $1 trillion package from Germany gets into effect, before there's a Ukraine settlement. All these things mean rebuilding, beefing up the infrastructure, the defense. All this is very, very positive. So Europe is super attractive, and Japan is out of the deflation period. If the Chinese consumer comes back after some trade deal, Japan also looks very, very attractive here.
That's interesting. Is there, you used the term AI bubble. I was going to get to this later, but I'm just curious. Does everybody here agree? Is there an AI bubble right now? Is there not an AI? Or is it just very high valuations? The companies are legitimate, right? The difference between a bubble and a legitimately overpriced thing is people are going to grow into it. It's just going to take some time. Jimmy, your thoughts? Is there an AI bubble?
There's AI, and there's a lot of capital formation, and some of that is probably at bubble-like prices, and some of it is potentially cheap. So, we try to. Part of our flexible mandate is that we are equally happy to be, sort of junky little small companies at 3 times earnings as we are to pay 30 times earnings for something that we think is going to grow at 30% for a really long time. We developed that second skill later. We started in the first camp, and then at some point said, let's try to do both. So there are certainly things happening in AI. This is that we're seeing more in the private market, or sort of calling it pre-IPO is generous because it's like very pre-IPO. But in the private market, if someone has a good idea and a good storyteller, sort of just make up a valuation. And if it's AI, that can be $5 billion, or, if you're Elon Musk, it can start at 18 billion, but you're Elon Musk and you probably have earned that. But, there is stuff like that kind of makes no sense. I shouldn't say makes no sense. Is speculative in nature and thereby could be called a bubble. Things that, the other companies, when the big tech companies say they're spending $50 to $100 billion a year, they actually are spending that. Like, the checks are going out each quarter to buy chips and buy infrastructure. That money is someone else's revenue. And so NVIDIA, if you believe that, by the way, we have a tiny position, so this isn't some core view, stock goes up and down a lot. But if you think the spending is going to continue for a few years, it might be the cheapest stock in the S&P 500. If you think that everyone's going to buy a lot of chips for a couple of years and then either have too many chips, or someone else is going to figure out how to do it and undercut them on price, or the technology is going to evolve such that you don't just need the NVIDIA chip, there's sort of a better way to do it, it suddenly looks expensive. But
does the fact that you have a tiny position mean you don't know the answer to that question, or you don't have a view?
We don't know the answer to the question. We generally, this sort of applies to everything we do, either the price can change or the information can change. We're best at the price changing part, right? So if NVIDIA gets to a price where you don't have to believe much, you're allowed to believe that there's huge orders for 2 years and then no one orders one for a long time, then we say we suddenly have a strong NVIDIA view. When the thing you have to do is be really smart, like you have to know what happens in 3 years, we're just less good at that. So making the big bet on information or news, in the case of tariffs, like if you had to know what Trump was going to do, that's a harder bet for us. Yeah. If you get to buy something 40% lower than it was the day before and it's probably going to be fine, that's easier for us.
I'm going to get back to AI in a second, but Alex brought up you want to defend your bubble?
Yeah, no, I just, just on the video, respectfully, as an example, because it's a, $2.5 trillion, I don't know where it is now, market cap company. When Cisco was at 550 billion at the height of the tech bubble, it peaked out at 25 times revenues. And if you look at technological obsolescence risk, if you look at just the DeepSeek came across, the fact that there is cyclicality to this capex that you're talking about in data centers, et cetera, to have a stock like this with the risks that are involved, obviously they are a premier company, but they're trading at 15, 16 times revenues. They're down from 2025. They are growing phenomenally, but any hiccup in growth, any technological change, the margins right now are huge because everybody wants these chips and they're paying whatever for it. The moment there's a little slowdown in spending, a little bit of a threat, not only will the sales drop or become a lot less growth, you have the margins dropping a lot. And so then the stock can go from a $3 trillion market cap where it was to 1 trillion or to 500 billion very quickly. So it's a huge risk. And the same is at Palantir. Tesla in its own way, which is as a car company worth maybe 50 or 80 billion, is trading at 800 billion based on promises of full self-driving, humanoid robots, etc. So that's definitely a bubble, those three stocks, and there's a bunch more below it.
Well, actually, let me stay on AI for a second to ask something in a different way, which is about your industry up here, and I'll get back, and we'll get into the active versus passive, which Alex brought up, which I'm going to just guess there's uniformity up here, just guess based on who we have here. Listen, let me ask you, a lot of you, all of you, get paid in large part to be the pickers. That's your job, right? What's the argument for why being the picker isn't going to be automated relatively quickly? I mean, are you dinosaurs up here? Is this the last generation of human pickers?
I hope not. I think.
I mean, you'll be okay. I mean, like,
I'll get to retire.
when you go into your office and you see the 22-year-olds, do you think, oh, you should really learn a trade?
Well, I mean, you have Bridgewater who said, for several years now that like AI is, I don't know, it goes from like 2 years to 2.5 or 3 year analysts or something like this. But the issue is you can't hire someone in as an 8-year analyst. I mean, you kind of have to go through that earlier point, and so it's a little bit hard to eliminate it completely. And I also think that there's the issue of sort of inflection points, and I think that if and history does repeat in a way, but it also kind of rhymes, and it's a little different sometimes. And I mean, Trump 2.0 is not the same as Trump 1.0. And so if AI or other things took lessons from one and said, okay, that's completely applicable now, that's not what we need it to do. And so I do think that there's still, at least today, a role, and that these times when we have to envision something different, that we actually have some real capability there that has not yet been mastered.
It's interesting. I mean, when I think about, and Steve, because you guys obviously have a lot of private market companies, some of those, as Jimmy called, very pre-IPO companies, maybe in the AI space. And I remember Ben Horowitz of Andreessen Horowitz was talking about this recently, and his argument was, well, they might be able to do the picking, they won't be able to do the stuff after. It feels like with a lot of these investments, these earlier investments, that if they're correct, if the bets are right, it does disintermediate all of you in the right. Like if the bets are wrong, if these things don't reach their promise, then they don't reach their promise, and so be it, and they're bad investments. But that if the investments are correct, ultimately, you don't need someone to run to do either to manage allocations, to pick stocks. An algorithm should be able to do that better. It's going to have more information, much more information, and process it better.
Well, I would say a big part of my job is not necessarily just the allocation or the picking stocks. A big part of my job is actually managing the people.
But if those people,
don't exist,
Yeah.
I guess, then yes. But there's, I mean, our sort of, I don't know, catchphrase for Common Spirit Health is "Hello, human kindness." There was some discussion earlier in the conference about the benefit of AI, and even without doctors sort of making good diagnoses. But there's still something with the humanity that you connect with people on that actually helps them become healthier. When you're empathetic with people, when you listen to people, when you truly hear the concerns that they have and the problems that they're expressing, and you connect with them. I don't think we're going to be eliminated quite yet.
Let me go to the active passive thing. Ryan, I'll start with you on this. Actually, do you feel, we being the markets, have we hit peak index? Are we on the back side of that at this point? Or are we still on the mountaintop?
I think it's challenging to say. I mean, the forces ultimately that are driving that is where are, you could say, institutions or retail allocating their money towards. To the extent that BlackRock, for example, a large index firm, is receiving more inflows, they're going to continue to put those strategies in. And if that inflow is greater than what is going to active managers, then certainly we're going to continue to do that. I think over time, obviously having better returns for an active manager is going to be more helpful to prevent that. The way we kind of think about it for our strategy, though, is we're perfectly fine if passive inflows want to increase, because that is ultimately a machine that, if you think about it, is not really intelligent in the sense of it is just allocating money towards a formula where the companies that are doing better get more of that money. And there's no decision making involved based upon new events other than price. And so for an investor like us, that presents opportunities where more money is going towards not using the evolving facts and business judgment to make a purchase decision, which just means there's ultimately less competition for us to be able to take advantage if we have a different view than if something formulaically is going up in order to be bought. And I think this actually delves in pretty well with the AI topic. The way that we think about AI is ultimately AI is brilliant at taking a set of historical information and being able to use that to predict the future. But what that really requires is that the past is going to look very similar to the future. And I think in investing, and Alyssa had made this point, things change very rapidly. And the further that you get out from the present, the harder it is to envision the way in which it would change. So the way I think about AI is that if you're running almost a machine learning trading strategy where you're trying to calculate the next tick, I think AI is going to be very powerful. If you're trying to look at a strategy where a company may beat quarterly earnings, I think AI can be quite helpful in that. If you're trying to do what Pershing Square is doing to carefully select 10 to 15 of the best businesses in the world based upon our view about what the future is going to look like 5 or 10 years out, I think the challenge is that AI may have way more information than we have, but figuring out ultimately how to use that information and take into account new situations that haven't developed, I think we're still very far from that, and I think AI is actually going to not be nearly as powerful as a lot of people think in that regard.
I'm curious, when any of you hear active ETF, active ETF manager, which is a phrase, how do you view that? Because those of you who are active managers, I don't think would put yourself into that category. It's obvious it's not indexes; it's some weird thing in between. Is that it's not even in
that's
between?
Just business. That's just a fundraising tool. It's just instead of raising money as a mutual fund, which feels more old-fashioned than raise money as an active ETF, which allows someone to be an active manager but use the current technology or current form. But passive as a trend is only going one way. Like more capital will be passive. Every retiree that still has money with their stockbroker, when that retiree is no longer with us, wherever that money flows next will be ticker SPY, not with the.
Do you feel then that when it comes to getting investors for your funds, are you competing almost from a benchmark perspective? Do you? And I'm sure it's different in what's actually in your deck, but when you're actually having that conversation, your people are having those conversations, do you feel you're competing more against the indexes or more against your peers?
The decision, and these are the experts on my left on this. Someone up top, in this case, sitting right here, makes an allocation. Once that allocation is made, we then compete against everyone else in that allocation to try to get that allocation. But if we find ourselves trying to convince teachers that they should take money out of ticker SPY and give it to our multi-strategy fund, that is a very you have lost that. You lost that 4 quarters ago when the strategic allocation was set.
So Steve, make the argument for the allocation.
So look, I think what tools do you have from an asset allocation perspective? Just simply put, there's diversification, which is a very powerful tool, and then there's active management. And active management is extremely accretive to delivering risk-adjusted returns. And so the more active management that you can put into the portfolio that's going to be persistent and deliver it at a cost-effective way, the better the overall portfolio is going to be. The challenge is that's really tough. Doing that's a very difficult exercise. There's certain instances where fund managers can do it for short periods of time, but really finding that genuine, repeatable type of process that is going to work through every market environment and every set of circumstance is really difficult. And so I think that's where we try to spend a lot of our time from an asset allocation perspective. But make no bones about it. Again, the quants in the room might not be happy with a statement, or it might be incorrect, but active management is probably almost as powerful as diversification in terms of that overall accretion to the risk-adjusted return, but it's just a very difficult thing to do on a consistent basis.
Alyssa, you've said that you're not here, but in pre-call that your bias is toward active managers.
Absolutely.
Why is your bias toward them? And talk a little bit about the trade-offs on that.
I mean, we use passive for cash management purposes to sort of even out asset allocation on the margins, but we've been able to find good managers who deliver alpha, and I want net of fee returns, and so if I can get higher net of fee returns, which I can get with active management, then I'm going to be doing that. And that's across every area. I mean, in public markets over 5 years, we have an average 1% annualized, and that's with a very low tracking error, and so I'm good with that.
All right, then with it, sure.
Sorry, the only thing I was going to add, both active and passive, similar to some of the other asset classes, from our perspective, I think from yours as well, because you're using some passives, are just different tools in the toolbox, and I think sometimes people get really fixated on one category versus the other, but from a broader portfolio perspective, they are just tools to implement a view, and they have pros and cons, and you just need to be going with that mindset.
Yeah, I mean, I will say one of the more interesting, in terms of that tools and building on that, I mean, one of the more interesting uses that we had recently was and it feels less good right now, this moment, but a few years ago we were underweight, or we realized we were quite underweight a year ago, Mag 7, going back to your point about how much those stocks had rallied. And all of our managers were underweight, and we're like, oh, this is not great. And it got to be a larger risk for us than we were comfortable with. And so we used an active, an ETF, a tech ETF, to not eliminate that underweight, but to reduce the underweight to a level at which we were comfortable with. Now, that hasn't, like in an ideal world, I'd go back and not do that, but given the recent last 1 month of performance. But fundamentally, it was the right choice, and it's still the choice I would make today if we were in that, because I want to be thoughtful and intentional about the risks and the positioning that we're taking. And if there's a risk that becomes uncomfortable for us, we're going to try to eliminate that risk. But overall, we want our managers to be making those decisions and investing in the things that they want to invest in, and using that active management to generate alpha for us.
Speaking of things we want to invest in, Jimmy, you've talked about how you guys try to find things that fall between the cracks. What do you think right now is falling between the cracks, and how do you ensure that the thing that fell between the cracks is actually valuable and not trash that someone just doesn't want to pick up.
Sure. So during the chaos of April, there were a lot more of these. I don't know if the cracks get wider or the amount going through is more, but if you're standing underneath, there seems like you're getting rained on when that happens. And that really came up across all markets and everything from if you do convertible bond arbitrage. There are Chinese convertible bonds that, because China's at the heart of all these issues and there's just general fear, and so there's a degrossing that happens, a liquidation, and kind of bizarre price action occurs. There are a lot of really levered players who use an instrument called dividend swaps, which just represent what the S&P dividend is going to be in the future. They're forwards on the S&P dividend. And there's some relationship they're always supposed to have versus each other, the 25 versus the 26 versus the 27. And again, players in that space are really levered players. When they do a degrossing, really weird things happen. Or again, in the month of April, the height of the fears, you could sell a down 17% put at the same price as an up 5% call. That's called the skew. It normally has a shape to it, but the shape got really stretched. Why? Because on that April 7th day, people were really, really worried about the downside and less concerned about capturing the upside. So there's some of those more technical type of opportunities that come in these extreme periods of chaos. And then there's just the more fundamental kind, which is, again, the world of credit tends to be less efficient than the world of equities, although, again, parts of equities get pretty inefficient too, big and small. So in the credit markets, people tend not to look through the same way as in the equity market. So if you took a retailer that sourced half of its product from China and had a low margin, from before tariffs or before this period to after this period, enterprise value is about the same, kind of like the S&P, because people said, you know what, they'll figure it out. If you took that same name in the credit market, the enterprise value is probably down 70% because the credit market has a harder time. Yep. It's not good or bad, it just is. Has a harder time saying, forget about the next quarter or year, let's look 2 years forward. So part of that falling through the cracks is looking across all those markets for some of those funkier technical aberrations and then some of those big fundamental relative mispricings that occur because different markets behave in different ways.
Just quickly, Alex, I'm wondering for you, you talked about crypto and AI bubbles, and you've talked about kind of when you see a herd, I think you've suggested you should get out of the way of it and not join the herd. How do you identify that the herd is running away from something valuable? Or sometimes they're running away from a fire, and you don't want to be going in the opposite direction of the herd.
Right. Well, the herd is all the passive investing that was alluded to and mentioned earlier in the ETFs, previously mutual funds, now all ETFs, has congregated into these massive diversified portfolios, and the capital is being allocated to that almost automatically. I think AI might play a function for the BlackRocks and others to help automate that further, but it's a tool, productivity tool for so many businesses, of course, and it's immense. But as far as stock picking, if you go back to real active management, and there's various ways of slicing and dicing the public equity markets as to who's passive and who's active. My personal way is maybe self-serving, but it's you look at portfolios with less than 30 names. In fact, we have 10 names, and I think Pershing is quite similar in that degree of concentration. And I think all of us would agree, if you have 30 names, when you're 100% invested at 3% per name, if you're roughly equal, doesn't really matter. Stock picking starts to become less important the moment you go past that. And 99.5% of all professionally managed money, that includes ETFs, mutual funds, everything, is in portfolios with more than 30 names. So that's, to me, that's all passive. And you can be in a sector like technology or energy or whatever, but there you go. And that can be automated. But as far as really trying to put up numbers that are substantial over a period of time, gapping off the index in an idiosyncratic way, you have to be concentrated. And once you're concentrated, there's rules to the road. You got to have, rules that you can't go into super overvalued companies that you can't figure out what they're doing. You need to go into well-financed companies. You need to have a margin of safety. And then you have to roll up your sleeves, just like private equity does, in the public equity market to get to know the company, to get under the hood, under the skin of management, to get as much due diligence and feeling for what's likely to happen. And then you can size the position appropriately. That's active management. That's frankly, as a value manager or investor, that's all of us are that. In our personal lives, if you buy a house, you buy a car, or a dishwasher. You comparison shop, you kick the tires, you go out there. You want to give that to AI? No. I mean, you can use AI to see what houses are out there. But it's a tool. So I don't want to oversimplify it too much, but it's, you know, at the end of the day, you need to kick the tires, go out there and be commonsensical about what you're buying and do your homework. And the same goes for private equity, same goes certainly for public equity.
As someone who just bought a dishwasher, I will tell you, if AI can automate that entire process, I would hit that button immediately and let it go. Ryan, on the concentrate portfolio, so you guys just 2 days ago, yesterday? Was it yesterday? Yesterday. Wow, it's gone slowly, I guess. Yesterday announced that you were taking a majority stake or a bigger stake in Howard Hughes, and that this is going to become kind of a basis for more of a permanent capital vehicle. Can you just talk to me a little bit, kind of the thesis on that, and why do this with a real estate company as opposed to an insurance company or some other sort of company?
Sure. So we announced a transaction yesterday with an investment of ours called Howard Hughes Company, which we've owned for the last 15 years. The business is a very good business that operates in the real estate space. They basically create cities called master plan communities. But our perspective has been that while the business is doing very well, the business has significantly outperformed the stock over a longer period of time. And in our core historical strategy of selecting a portfolio of roughly a dozen names where we do a lot of deep business diligence, try to think about how the businesses will look over a long period of time, that feels a lot like what a private equity firm would do in terms of diligence. The exercise of influence that we have, even though we are a minority investor, feels a lot like the control-oriented if you owned 100% of the business. So we thought it would be a natural evolution to basically have a vehicle like Howard Hughes, which we will now manage. And we own about 47% of that company. And the goal there is to take what is a very well-performing real estate company and move into a diversified holding company where we'll be making control-oriented investments, private, public, owning more than 50%, sometimes 100% of them. And we think it's a very natural evolution of using the similar skill set, but it really widens the aperture where now we have the public markets that are available, but we also have non-public markets. And not only do we have the ability to be influential, as we do in our core strategy of a minority investor, but now we can be a control-oriented investor as well.
I mean, does it mean to you, and when you talk kind of long-termism versus the short-termism of the typical public markets, do you view then private equity as almost too short-term? Because what you're talking about is longer-term than a typical private equity hold.
Well, we're talking about forever, so yes, absolutely. I mean, I think one of the advantages of the Howard Hughes transaction is we can truly be a permanent owner. And so whereas a private equity firm can take private, ultimately they need to provide a liquidity strategy for their investors, typically 5 or 7 years. We have the ability to present an owner of the business with a proposition that they can join us. We can buy them for cash and own their business forever. We could also, at the appropriate price, we could look to have our currency be available for stock acquisition, which would be beneficial for them diversifying their assets in a tax advantage way potentially. But yes, the view is a permanent capital strategy, both on our core historical equity public market funds, as well as in the Howard Hughes vehicle, provides a number of options, but all of this is at a long-term orientation. If you will, the asset side of our balance sheet, what we're trying to invest in, we want to match the duration of the liability of our balance sheet, which is basically forever.
Does Howard Hughes and everything that kind of gets added on, whether you want to call it a platform or something else, or under the umbrella of it, is that ultimately what Pershing Square is? In other words, it's not we've got Howard Hughes and then we've got X, Y, and Z positions in these other things. Is everything ultimately in the long-term view under that?
Yeah, the way we think about it is effectively the way we spend our day in thinking about businesses and thinking about making investments. Those skills are very applicable to a wide range of things. Our mandate historically has been minority public markets investments, but the work that we would do, the vast majority of that work is very applicable to other things. And so we're trying to find ways to create additional value. It would be great to be able to buy an investment where you like that investment, but you're able to make a 20% holding as a percentage of that company's value. We can do that now, but what we couldn't do is take 20% and go to 100 over time. And now we have another area to be able to do that.
Let me ask you one other question. Steve, I want to ask you about private equity and M&A stuff. There are some fund managers who shy away from the spotlight and wouldn't even want to come to Milken. There are some who run in front of every TV camera that's possible. You may work with one of the latter on that group. I guess I'll ask it this way. Your job being CIO, Bill's profile and things that are not investment specific related, how does that impact your job, if at all, in the business of the investment business of Pershing Square?
I mean, I think that on a day-to-day basis, Bill and I work very carefully together, in selecting the investments that we make. I think that Warren Buffett once said just because he was the CEO of Berkshire Hathaway didn't mean that he had to put his voting card inside his wallet and never talk about it again. I think Bill has a very large platform. I think it's been very beneficial for our business overall.
How so?
Well, he's one phone call away from just about every major political figure, every major economic actor, every business owner. And a lot of people want to hear his views. So I think he's been able to use his views as a platform that has ultimately allowed us to gain more connections with people that we'd like to have connections with than if you think about 20 years ago. So I think that that's been very helpful for our business. But I also think, aside from the help for the business, that's not the reason he's doing it because he wants to express his views, because he wants to be a citizen that's trying to help improve the world. And I think that people who are in our business should certainly have the right to do that. But on a day-to-day basis, I think that it really doesn't change the way that we operate, which is the same way we've operated even before anybody ever heard of Twitter.
Let me just ask you one quick follow-up. I'm curious. You talk about being one phone call away, particularly on the political side. That's because his guy won. If his person had lost, would you feel differently about this? Because you wouldn't only not necessarily be one phone call away, you might actually be getting hung up on.
The way I think about it is that ultimately we will, Bill will express views, other people will express views. And the way we think about it for our business in particular is really just about our ability in order to have additional conversations. We, in the public markets, we don't need to talk to anybody in order to do the work to buy a stock. It's one of the beauties, as Alex mentioned earlier, about having 15,000 companies, with a market cap of over $100 million. In the private markets, relationships are helpful, and I think that we've, over time, really tried to develop a larger network of relationships we have. And I think with Howard Hughes, that those will prove increasingly valuable as we try to negotiate, business transactions.
Speaking of the private markets, Steve, and then I'll go to the audience questions. Thank you for putting them on my iPad up here. It's magical. There's been we talked. The M&A market has been relatively dead. The IPO market has been effectively dead. There's been a handful, really over the last several years. There's been a handful. At what point are you, when you look at your private equity, your venture capital portfolios, all of which Teachers has a lot, both direct and indirect? Yep. Are you concerned? Is there any concern that the private equity model, at least the way we've known it for 20 years, doesn't work anymore?
I think we do spend a lot of time from an asset allocation perspective thinking about what is that excess return going to be. And you're right, it has been a very challenging space over the last couple of years. And you're seeing that in low DPIs and, frankly, in terms of performance that hasn't been quite at what everybody would like it to have been. And so I think when we look out over the next 3 to 5 years, I do think we look at it from more of a headwind, tailwind perspective as opposed to giving a precise estimate. And some of the drivers of that excess return that we've seen over the last decade, call it low leverage, multiple expansion, so financial engineering, feels like those are going to be a bit more challenging going forward. And so that's one aspect in terms of how you think about what those excess returns might be. I think the other component of things, and one of the benefits of private equity, is the ability to actually use trading off illiquidity and governance to actually drive the business in a direction that you feel is appropriate and that is going to actually add value to the enterprise over the long term. And so we have spent a lot more time of late, and we've just announced a new group to help support this particular effort around that value creation and really kind of going back to basics in terms of those value drivers, in terms of revenue expansion and or kind of maintaining margins and so on and so forth. And so that is one area that is certainly an area of focus from an asset allocation perspective. I think the other way that I think about it is that if you used to assume that there was 1,000 units of excess performance, and now you've got these headwinds, it doesn't mean that goes to zero, but what it means is that at the margin, you probably want to be a bit more selective in terms of what opportunities you're pursuing so that you can make sure that you're delivering on that risk-adjusted return equation in that space.
Looking at this, Alyssa, a question for you. You've got kind of a dual mandate. Your primary mandate's obviously fiduciary, but also the organization has a mission. How do you kind of balance those two? And are there certain sorts of investments you won't make, even though you think they would be good ROI, because they are in conflict in some way with the organization's mission?
Well, I think we always have to align. Any organization has to align along with, regardless of the organization itself may have views that are inconsistent due to risk return restrictions as well. We don't invest in crypto. I think that the current administration makes it likely that crypto is going to be a great asset for financial returns for the next couple of years. I also personally view that probably in the next 4 years we'll see another major fraud in that area. That risk return is not appropriate for my organization, so we will not do that. That's not a bias against it from a mission standpoint. It's inappropriate from a risk return standpoint. But we actually think about both on the positive social returns of as well as financial returns. And when I can find both, that's really my ideal. I don't think that those things are inconsistent. We've had some fantastic places where there's really impactful returns as well as great financial returns. And we've outperformed our kind of financial policy benchmarks over time. And that's the primary goal of the investment program that I oversee. We do have dedicated allocations both to grants that we make in our area, focusing on social determinants of health, as well as a small program in concessionary lending. And so those are really geared again around thinking about those health issues. But we absolutely, when we're looking at things, we try to understand the full risk return parameters of everything and what are we getting for the money that we're investing.
Got a question here, kind of on the geography or geopolitical front. Alex, you talked about being in 3 or 4 markets, depending on how you want to bifurcate the U.S. Does anyone have any thoughts here? Somebody asked, so I will ask you about the Latin American market because that hasn't come up at all here. Is it a place anybody's putting money right now, or any thoughts?
I'm not investing there because if I take my universe of $2 to $20 billion market caps and I exclude finance and commodity-dependent companies, there's very little for me to invest in, so I stay away from those markets.
Stay away from those markets. Jimmy, you brought up, you happened to bring up XAI just as part of another conversation. Would you invest in it right now if you had the opportunity?
So I personally had the opportunity at 18 billion. I was like, come on, 18 billion for something that doesn't even exist, even attached to Elon Musk, and I didn't do it. And I think the last round was at 75, which was about 3 months later. So it was a miss.
Can I ask, so do you think it was a miss? Because just because it got priced at 75 doesn't mean that's what you could ultimately sell it for.
Empirically, you could sell it.
Well, sell into that
private
round,
markets.
Sure.
This is this whole other hour panel. This one's about to end, but private markets are not so private anymore, right?
Yeah.
So certainly these large private companies that do raises, you could buy shares almost as easily as you could sell shares. Again, that applies to the 75 billion Elon Musk companies, not necessarily a tiny little private company.
Final question, just a very quick one. I said I was only going to go up and down the line once and maybe at the end, so I'm just going to start with you, Ryan, very quickly because we're almost at the end of this panel and we're day 2 or 3 for some people of this conference. Give me one quick Milken conference hack.
Milken conference hack?
Yeah, that you use to make this worth your while and make it work better for you.
I'll tell you one thing. Anything that I really want to make sure I get done interrupted in the morning, being on a 3 hours East Coast to West Coast, is waking up at very early here, normal time East Coast. Nobody is downstairs, and it looks like this conference had never existed. So anything you need to get done, when I get done quickly, it's here. Wake it up early.
Got one, Jimmy?
Pre-planned. I thought it was over the top the way the schedule had been laid out by the folks at Sculptor, but it turns out planning in half-hour increments is a good idea.
Steve?
Yeah, I think when they were walking us over here, they took us through the back area. So I think that's the hack to kind of get to this set of meeting rooms.
I think planning and being clear about saying no to some things. There are at any given point in time like 8 things going on, and of which 3 of them I'm really excited and interested in participating in. I think some of the private sessions, if you get invited to them, are fantastic, and I try to go back, although it's hard to make the time to view some of the public sessions.
You got one, Alex?
Well, it's fabulously important at this conference. It's huge in its convening capacity and the subjects matter. But personally, it's wonderful to address you all on value investing, and hopefully you'll take that away. So it's nice to have a forum to talk about it.
I'll give mine for what it's worth, I guess, in this case, which is similar to yours. So there's next to that like kind of big square bar and whatever room that is, there's a table right next to the staircase, and if you show up early enough, 5, you can sit at it, and absolutely everybody passes that table. The problem is if you get up because you want to use a restroom or get coffee, you lose that table. It is unsavable. Everybody, thank you very much for joining. Thank you guys for coming.